Hello, so today I'm going to be explaining the yen. Okay, I'm going to tell us what has been happening around the yen. I'm going to also explain to us what transpired last week, where we had the Bank of Japan officials intervening to avert the seeming or persistent depreciation of the yen, which is the country's national currency. I'm going to also tell us the history as to what has actually triggered this seeming limitless yen depreciation and what to look forward to. Remember, in the course of our previous videos, I've called out the yen. I've explained to us why you needed to short the yen, why the yen has provided some free money, why the yen has remained the sacred cow. Okay, so today I'm going to be explaining all of that in a single video. So before I continue, please do well to subscribe, like, and share this video so that it goes to as many persons that can benefit of this video. Okay, the goal still remains to pull people into this knowledge zone, pull as much as we can so that we get people to really understand what is happening around them. So now to the first point, the history of the yen. Remember, after the World War II, Japan went into some level of economic prosperity. In fact, those decades were dubbed as the most successful era in Japan's history. What am I talking about? From 1955 down to 1990, Japan actually experienced some level of growth. They also experienced prosperity, and to that effect, they had a stable growth rate. They also had a stable interest rate, and they also had some level of steady GDP rate, and everything was really going well for the Japanese at that time until the early 90s, within 1990 down to 1999, where the Japanese suffered a very huge economic setback. They were in crisis. They ended up having a stagnated economy. Now, within that period, they had growth going about close to zero. Well, they also had interest rates going close to zero, and they also had some deflationary pressure. So you're going to ask yourself, what happened within 1990 to 1999? That period was a time when the Japanese economy witnessed a substantial crash. And at that point, residential property value dropped more than 50%. Commercial property value dropped massively to about more than 85%, and the Japanese main stock, the Nikkei, dropped to more than 75%. So you can imagine the huge loss at that time, and the economy witnessed a significant downturn. After that significant crash, households and corporate bodies started repaying their loan, because come to look at it from the common sense aspect of that. At that time, if you had bought a mortgage before the period of the crash, it was almost very reasonable for you to concentrate on paying those your mortgage, because the value of your residential property crashed by about 50%. If you are a corporate body, the value of that corporate mortgage which you had taken crashed by 85%. So it was almost very, very wise of anybody or any corporate body to do well to pay that debt at that time. So what happened? People or Japanese authorities, Japanese individuals concentrated on paying back their loans, paying back their debts rather than borrowing. Japanese economy suffered massive deflation. The Japanese authorities looked for ways to try and see if they spring forth inflation by trying to buy up corporate and government debt, trying to pump money into the market, trying to encourage people to spend. But it was almost obvious that people were concentrating on repaying back their debt, and that made Japan become a debt-burdened nation. They had so much debt to such an extent that if they had increased interest rates, it would have been costlier for them to service the debt, because it's going to jack up the servicing and borrowing costs. So that's exactly why deflation persisted in Japan. Now, fast forward to 2022. But before we get to 2022, what the Japanese authorities were doing then by trying to buy up government government and corporate debt was what we refer today as quantitative easing. They are trying to pump money into the market to stimulate inflation. Now, fast forward to 2022. 2022, much of the central banks decided to engage in quantitative tightening. Quantitative tightening means removing as much money from circulation. And when you look at Japanese authorities, were busy pumping in money into the economy. Other central bankers were doing what? They were actually tightening, and they were actually taking out monies from circulation. And then you have the price or the policy differential between the Fed and the Japanese authorities. Now, the Fed, it was easy for them to jack up interest rates in a bid to fight inflation. But Japan are already in a deflationary environment. They couldn't have jacked up inflation. Remember, just like I said, even the smallest hike in interest rate would mean a significant debt burden in Japan, because they already have a massive debt to GDP ratio, and they wouldn't artificially increase their debt burden. And so it remained like that. Now, others ended up tightening, and Japan remained deflationary, and that had caused a stagnation in the growth of the economy, interest rates almost zero or less than zero, and Japanese currency weakened with time. So that's exactly why you see the Japanese currency, when paired with other currency, you find out that they've been weakening for a very long time. Back to what happened last week. We saw that if you look at your charts, whether GBP, US GBP, JPY, USD JPY, Euro JPY, all witnessed a substantial dip. What happened? The tightening. Quantitative tightening means removing as much money from circulation. And when you look at Japanese authorities, were busy pumping in money into the economy. Other central bankers were doing what? They were actually tightening, and they were actually taking out monies from circulation. And then you have the price or the policy differential between the Fed and the Japanese authorities. Now, the Fed, it was easy for them to jack up interest rates in a bid to fight inflation. But Japan are already in a deflationary environment. They couldn't have jacked up inflation. Remember, just like I said, even the smallest hike in interest rate would mean a significant debt burden in Japan, because they already have a massive debt to GDP ratio, and they wouldn't artificially increase their debt burden. And so it remained like that. Now, others ended up tightening, and Japan remained deflationary, and that had caused a stagnation in the growth of the economy, interest rates almost zero or less than zero, and Japanese currency weakened with time. So that's exactly why you see the Japanese currency, when paired with other currency, you find out that they've been weakening for a very long time. Back to what happened last week. We saw that if you look at your charts, whether GBP, US GBP, JPY, USD JPY, Euro JPY, all witnessed a substantial dip. What happened? The Bank of Japan actually intervened in the FX market. And you're going to ask me what's the meaning of their intervention. Japanese authorities intervening in the market means they're trying to reduce the excessiveness of the moves, right? You see the rapid moves within the Japanese currency. You see people selling more of Japanese, so they are not happy with the level of depreciation of the yen. That's exactly why they are intervening. And how do you want to ask me, how do they intervene? They intervene by trying to buy up enough yen in the FX market, and by so doing, they are artificially propping up the price of the yen in the market. And that's exactly where you witnessed, just like your GBP JPY, they were selling GBP JPY to buy yen. So that pair actually witnessed a sell. It witnessed a substantial dip. And because the Bank of Japan actually spent so much buying up yen in the Forex market and artificially inflating the price. Now, they have done that repeatedly. They've warned against speculators speculating on the yen, because the speculations and all what you've had transpiring within the FX market had heaped so much downward pressure in the yen, and the Japanese authorities have maintained that they will do whatever within their capacity, even if it means spending lots of money on Japanese yen intervention. And that's what they do. They spend billions of dollars or billions of Japanese yen because Japan has one of the largest foreign reserves in the whole world. So to that effect, they have enough money to spend in the FX market. So they decided to take a chunk of their foreign reserve to buy up yen in the FX market. And that's exactly why you're seeing those significant depreciation in the pairs that involves the yen. Like I said earlier, do well to share, like, drop your comments. If there's any aspect of this video you need to comment, maybe you want to share one of your experiences, please feel free to do that, and we'll be happy to hear your views and also hear your thoughts. Until the next video, enjoy the rest of your day.